Hello, and welcome to another great video by Mr. Clark. And in this video, I'm going to explain the importance of identifying risk in industries and the stock market. But for right now, enjoy some nice, soothing piano music before we get into identifying risk. Learning Standard 4, Unit 2, the stock market. In this episode, we're going to look at some of the stock symbols that are used to evaluate risk in stock companies and help you identify whether companies are considered a high risk to invest your money into, mid risk, or low risk. I hope you're enjoying the tone of my voice. I'm being rather silly on this Sunday morning. Let's get into it. What I recommend is that you take notes on each slide. We are going through slides 93 to 98 today. And that as you take notes, pause the video and then play it when you're finished writing down the information and listen to the verbal notes that I provide. To help you understand this, I'm going to skip ahead and show you a couple examples of stock symbols. This is one for Google. This is one for News Corporation. The terms we're going to look at today are market cap, price to earnings, earnings per share, and a beta symbol. We're going to start off with a beta symbol, and then we'll get into some of these, including volume and 52-week range as well. Some of the notes I provide are in the slides. Some you'll have to listen to from me to help you understand some of these terms. The first one we're going to get into is the beta symbol. The beta symbol was created by stock market investors and mathematicians to help identify how risky an industry or a stock is. So a beta symbol uses an algorithm, and to help you understand that algorithm, I provided a hyperlink there that you're welcome to click on, courtesy of Investopedia. And that link will take you to an article on Investopedia that helps you understand the algorithm and how to use a beta symbol. But for right now, let's look at the beta symbol for Google and for News Corporation. So News Corporation has a beta symbol, which is listed right here, of 1.001. It's essentially 1. Whereas with Google, it has a beta symbol of 1.2. What this means is that if you were to look at News Corporation and compare their performance to that of the S&P 500, the S&P 500 is an index which ranks the 500 top earning companies in the United States. So those would be companies like Walmart, Amazon, Nike, Berkshire Hathaway, etc. And so if you were to compare the performance of News Corporation against those companies, that beta symbol tells you that as the S&P 500 increases by 10%, that News Corporation's value will increase by 10% as well. If you have a beta ratio of 1 to 1, which is essentially what News Corporation is here, it's a 1-to-1 ratio, that tells you that this company's performance and stock performance closely follows that of all the other industries and businesses in the S&P 500. But with Google, notice that Google's beta symbol is a little bit higher. It's 1.2. So a beta symbol of greater than 1 tells you that this company is a little more volatile, meaning that if the S&P 500 fell by, say, 10%, then Google's stock price is going to fall by 12%, and vice versa. If the industry was going to rise by 10%, Google's stock price is going to grow by 12%. So a beta symbol essentially helps you identify risk. If you are in this as a day trader trying to make a little bit more money, maybe companies like this with a higher beta symbol are for you. You have to be willing to take some risk here, but the reward is that the company is going to outperform the performance of the rest of the market if it has a beta symbol of greater than 1. You might be wondering, what does a beta symbol less than 1 indicate? That indicates slow growth, conservative growth, and it's a safer bet. So some examples of companies or industries with a beta symbol less than 1 would be utility companies, companies that aren't as responsive to changes in the market. So for example, if you had a company with a beta symbol of 0.20, that would tell you that if the S&P 500 index fell by 10%, that industry's stock price is only going to fall by 2%, but also vice versa. If it has a beta symbol of 0.2 and the S&P 500 grew by 10%, that company's stock price is only going to grow by 2%. So if you're in this for the long term and want to make take more of a conservative approach to the market, maybe utilities are for you. Maybe companies with a beta symbol of less than 1 are for you. But if you're in this to make money quickly, understanding that you're also going to take some risk, companies with a beta symbol greater than 1 might be for you. If you're looking for certain industries that have beta symbols greater than 1 usually, a lot of the startup companies and tech stocks are some of your companies with beta symbols greater than 1. Because startup companies tend to fail more than 50% of the time, and technology stocks tend to fluctuate rapidly with changes in the market. So hopefully that helps you understand the importance of a beta symbol. And again, I encourage you to click on that link if you'd like more information about it. Here's some other information about what is on a stock symbol. So that information is listed here. What we'll start with, we'll work from the top and go down. 52-week range, what that indicates, the 52-week range is showing in the last year how a company's stock price has fluctuated. So right now you'll see that the stock price for the day for Google is $697.25. If you look at how the stock has been doing over the last year, this tells you that the stock is a little bit closer to its higher price for the year than the lower price. So this might tell you that now might not be the best time to buy Google stock because this is a company that's starting to inch upward. Even if they've fallen for the day, their stock price for the day is much closer to their annual high than their annual low. The volume is the total amount of shares that are being traded for that day. So on this day, whenever this was, the amount of Google shares that were being bought and sold in the market, 970,625. The higher the volume, that means the more interest there is in buying the company. The lower the volume, that means the less interest there is in buying the company. So if you're looking at comparisons, you'll have to look at how Google compares to that of other big cap stocks or to that of small cap stocks that maybe represent startup companies or companies that are just going public for the first time. If you're looking at this as trying to use volume as a way of determining the value of a stock, keep in mind that the more the volume, the more interest there is, and then probably the price is going to be higher. A stock that has lower volume probably is a stock that might be undertaking some trouble, or it's just gone public. Market cap. Let me go back to my slides here. What market cap means, market cap shows the value of a company, how much the value of a company is when you look at the price of the company and the shares of the company. So to determine market cap, you would take whatever the stock price is and multiply it by its shares. So obviously, if the price of a stock is higher, that means there's more demand for it, more people are interested in it, which is not only going to help the price of the stock, but it's going to help the company too. So obviously, if you were to look at Amazon or Google here, Google has a market cap of over $200 billion. That's tremendous, and it's going to fall into the category of a large cap stock. Large cap stocks are proven companies. They're companies that probably have a lower beta symbol because they've made it, they're out there, they have some competitors, but they're at the top of the market, and they're a company that's highly sought after by investors. A company that's just getting into the market would be an example of a small cap stock. A small cap stock would be like a company that's just making around, say, $1 billion or less than that. That might be a startup company, maybe a company that's on the decline. So, market cap is another way of measuring the value of a company. Obviously, the higher the market cap, the more interest there's going to be, the more return for you, but also you're going to have to pay more in order to purchase that stock, as indicated by Google's stock price here. What price to earnings ratio means, price to earnings ratio shows how valuable a company is relative to its earnings. So every quarter and every year, a company will release its earnings. And you can see right here, Google is set to release, this is from a long time ago, this is from 2013, I just copied and pasted it courtesy of Google. But Google was set to release their annual earnings on January 22nd of 2013. So, every time a company releases its earnings, it gives investors an idea of how the company's doing. The company will make a prediction about how it's supposed to do, and if it falls below that prediction, it's going to hurt its stock price. If it falls above its prediction, or if its earnings are above its prediction, it helps its stock price. If you're wondering what that means with price to earnings ratio, what this tells you is that a price to earnings ratio of, say, 21 means that the stock price is 21 times greater than its annual earnings. So the higher the PE, that means it might be a little more overvalued. It might be more expensive. Actually, it definitely is more expensive. And it might be overvalued. There might be a bubble here. A price to earnings ratio closer to 10 or 5 would indicate that the stock is performing along with the value of the company. So what to keep in mind here, a greater number means that the value of the stock might be inflated. There might be too much demand, and at some point that bubble is going to pop. A PE of closer to 10 or 15 or 20 even tells you that the stock price is running relative with the earnings of the company or the performance of the company, because the performance of the company is really based on how it's doing, its earnings. Keep in mind, earnings is the profit that the company is making. Profit is what the company takes home after it pays its costs. Earnings per share, what you do there is you take a company's profits and divide it by its shares. So if you look at Google here and were to compare its EPS of $31.91 to that of News Corporation, this tells you that News Corporation, their earnings per share is down for the day of $1.55. For Google, it's up $31.91, which means that it's doing really well, and therefore the company's highly valued, its profits are doing well, and it's a highly valuable company. So one takeaway here with EPS is that the higher the EPS, the more valuable the company is, but therefore the higher the stock price. This should help you understand some risk with stocks. Some of this information I've talked about already with the beta number, but if you are in this for high risk, you're going to want to search after stocks that have a higher beta number, maybe stocks that have a low or mid cap that have a chance to really grow in a short amount of time, and stocks that don't have a proven track record. The risk is high, but the reward is even higher. If you're in this for the long term, if you want to see conservative growth, but growth that is reasonable and moderate, you're going to look for stocks like utility companies, companies that have maybe more of a large cap. Maybe you want to index it with the S&P 500. You want to keep the beta number low, and you want to keep the price to earnings ratio low as well, maybe between the 10 to 20 range. If you're in this for high risk, maybe a price to earnings ratio of greater than 30, because there might be a bubble, but you might be able to cash in on that bubble and get out before that bubble pops. These are some other things to consider as well. Maybe the company is offering new products or is going to introduce a new product shortly. How the company has performed against the competition over the last 6 months to a year. Look at the company's 52-week range. Look at the company's earnings. Do the earnings come in below projections? Do they come in above projections, at projections? And how they're facing off against competitors. We'll do the practice in class or remotely. But to recap today, make sure you can tell me what a 52-week range is, what the volume means, what market cap, price to earnings ratio, and earnings per share mean. When talking about market cap, what is the difference between a large cap company, a mid cap company, and a small cap company, and how you'd be able to use the beta symbol to determine risk when evaluating a stock. I hope you enjoyed this video today and my monotone voice and my piano music. And hopefully you will turn into the next Warren Buffett or those people on Reddit that are really inflating the price of GameStop and making bank. Enjoy your day.